What's up, everyone? Welcome back to my channel, Wolves of Investing. My name is Donnie Nguyen, founder of Wolves of Investing. If you want to learn how to achieve financial freedom through investing, be sure to click on the subscribe button and the notification bell. In today's video, I'm going to go over 4 strategies for investing in a bear market. I'm filming this video in March 2020. During the COVID-19 bear market. Worst bear market since the Great Recession. The S&P 500 is currently still down more than 20% from its all-time highs. Before I get into these 4 strategies, I want to remind you guys I'm not a financial advisor. These are just my opinions based on my 20 years as a retail investor, having invested through the dot-com bubble and the Great Recession. I'm basing these 4 strategies on one primary assumption, that the S&P 500 will eventually make all-time highs sometime in the next 15 years. During the Great Depression, it took 25 years for the stock market to get back to all-time highs. But if you had started dollar cost averaging into the stock market just 4 years before the Great Depression, and never put any more money into the stock market, you would have made your money back in 10 years. That really emphasizes the power of dollar cost averaging. And in addition to my normal disclaimer that I post on every video, please don't do this with your emergency fund. Please don't do this if you've lost your job or lost your income. And please don't do this with any money that you're going to need in the next 10 years. So without further ado, the first strategy for investing in a bear market is to just dollar cost average into a low cost index fund, such as the S&P 500. A couple months ago, when the S&P 500 was at all-time highs, many of us were just socking money away into our 401ks into the stock market. Now that stocks have been beaten down over 20%, we can start buying those stocks at the lower prices, which makes up for when we were buying them at the higher prices. That's the whole point of dollar cost averaging. And that is one of the simplest ways to invest in a bear market. The second strategy for investing in a bear market is to rebalance our portfolios. For example, many of us have portfolios that has a percentage in stocks and a percentage in bonds. Maybe it's an 80-20 split, or maybe it's a 60-40 split. Let's say it's a 60-40 split, 60% stocks and 40% bonds. During this bear market, that 60-40 might start looking more like 40-60. By rebalancing back to the original target, we're able to buy stocks at the lower prices. So you might be wondering, when would be a good time to rebalance? And how often would you want to rebalance? Rebalancing doesn't really pertain to me in my specific situation because in my 401k, I have a 100% stock portfolio in my mutual funds. But if it did pertain to me, this is how I would go about it. First, I would wait for the S&P 500 to drop 20% before I do my first rebalance. Then I would do another rebalance if the S&P 500 dropped 30%, then 40%, and finally, I would do my last rebalance if the S&P 500 dropped 50% from its all-time highs. The reason I would stop rebalancing at 50% is because the S&P 500 has only dropped 50% 3 times in the last 50 years. And it hasn't fallen 60% in over 80 years. Since the Great Depression. If the S&P 500 were to drop 60%, things would get very scary. At that point, I will probably not have the guts to continue rebalancing. Before I talk about the third strategy, please remember to click the subscribe button, click the notification bell, and click the like button if you're enjoying this content. And if you're a beginning investor, after this video, be sure to check out wolvesofinvesting.com and download my free ebook if you want to learn more about investing. And also, check out my video, 3 ways to invest your first $1,000. I also made that video specifically for beginning investors. The third strategy is a more aggressive version of the first strategy. Instead of just dollar cost averaging the same amount you were investing before the bear market hit, you would actually increase that amount. For example, if you were putting in $500 a month before the bear market hit, now you might be putting in $600 or $700 or $800 a month. By doing this, you're aggressively buying stocks at the beaten down prices. In this bear market, I am currently using this strategy in both my 401k and my M1 Finance portfolio. Be sure to check out my monthly M1 Finance portfolio review so you can see exactly how I'm investing in a small account, taking that account from $0 to $1,000 to $10,000 and beyond. And the fourth and final strategy for investing in a bear market is to take any of your investable cash that you had on the sidelines and start investing into the market. For example, in my Roth IRA, I primarily invest in individual stocks. In that account, when the stock market is at all-time highs like it was a couple months ago, I normally keep 25% of that portfolio in things like cash, CDs, and short-term bond funds. When the S&P 500 drops 20%, I take that portion of my portfolio and divide it into 4 equal parts. When the S&P 500 drops 20%, I invest that first portion. I invest the second portion when it drops 30%, the third portion when it drops 40%, and at 50%, I'm all in. If you decide to follow this strategy or any of the strategies I talked about today, please just remember, don't use your emergency fund and don't invest with any money that you're going to need in the next 10 years. So those are the 4 strategies. Let me know what you guys think. Are you guys using any of these strategies? How are you handling the bear market? Drop me a line in the comment box. And if you haven't yet, please remember to subscribe to the channel, click the notification bell, and click the like button. Thanks for watching, be safe out there, and I'll see you next time.